In this video, I want to talk to you guys about SoFi actually being bought out because the price is just so cheap for the stock right now. And in fact, I went so far back as to 2017 where they actually got a buyout offer of $6 billion, which is the same market cap as they have today. So let's take this time to actually look at this article for where SoFi is talking about being bought out. And you can see this article here is actually dated on October 23rd in 2017. And they actually say down in the article that this is actually an offer that was made earlier in the year. But still, that's potentially even, Q1 or Q2 of 2017, where they got a $6 billion offer. Right here, you can see those sales discussions were brought up on a $6 billion offer from a foreign bank, according to unnamed sources. The offer followed a $500 million fundraising round, which left SoFi with a valuation of north of $4 billion, okay? Today, they're at $6 billion on their market cap now that they're actually publicly traded. So only a 50% valuation from where their own investors were, but for a buyout, it was $6 billion, which is just the price if you were to buy public shares today. But in this video, I don't want to just talk about what they were talking about back in 2017. Let's compare the two businesses, okay? Let's talk about what SoFi looked like back in 2017, where they had no financial services at all. And in fact, they only offered some, student loans, some personal loans, and just started getting into home loans. They had nothing in terms of the checking and savings, the investing accounts, the margin accounts, anything along those lines that actually make up for a majority of the members that they have today. Going back into the article, you can even see it says SoFi moved into talks with other possible firms for a buyout with a desired price of around $8 to $10 billion, which is what we saw just a couple months ago. And I was just scrolling along in the article and I found some pretty enlightening things. So SoFi has since grown its offering to include mortgage and customer loans, like I said. And it also says here, by reports, it's approaching a customer base of around 500,000 users. And before I even read that paragraph, I did very similar things trying to retroactively look at all of their growth rates. And I also saw a very similar numbers come up in my math as well. So 490,000 members as of Q2 of 2017, or around 516,000 products as of Q2 of 2017. But this is just retroactively looking at growth rates. Obviously, they can change, quarter to quarter, so those numbers could be very, very off. But considering that the article also said 500,000 was right around my numbers as well, it's safe to assume that that's sort of where it is. So just assume 500,000 members back at Q2 of 2017, all the way to now, we'll talk about the numbers, but it's just a completely different business for being rated at the exact same valuation. But this is where the meat and potatoes of the video actually come in, okay? What did the company not have back in 2017 that they do today that should add extra value to the multiple? I wrote down 15 points that I could think of, and man, I wrote these down in 2 minutes. It took me no time to think about these points. If I were to actually sit down for an extra hour or two, I'm sure I could have came up with 30 more, but these are just the ones that came to mind instantly. So one, banking license, okay? They didn't even have a banking license back then, and that's absolutely massive now, okay? What about the Galileo technologies? What about Technesis? What about the Pagaya partnership? What about the 4 million financial service products that they have now with all the users that have come in since then that have also started to get loans with SoFi, okay? Then with that, because of a lot of them are, with our checking and savings, that's growing direct deposit customers, which also lead to spending. So 100,000 new users of credit cards. What about 3.5 million users now versus 500,000 of 2017? What about, okay, place this into your $6 billion valuation, okay? Last quarter, we grew 523,000 users just in the last 3 months, okay? That's more than what we had in 2017 with the whole business all combined. This doesn't even include crypto trading that we do now, or the margin trading, or the fact that we're going to have options that are going to be coming out, which actually, whenever you look back at, Robinhood's last year, made up 69% of their overall revenue, and yet we're going to be getting into options trading, hopefully just as lucrative as what Robinhood's doing, which should really contribute to how we actually make our money here at SoFi. Not to mention even SoFi Lantern, which is our insurance program, which also makes us a lot of money on top of all these things. And add that all up, that leads us to around $1 billion of net revenue. Whenever you compare to 170 million just of like 2017, how can you really compare these two valuations? And that's not even to the fact that the CEO, Anthony Noto, wasn't even around in this company in 2017, and yet he's been the biggest driver, and some of the best successes that we've had in this company are because of our new CEO. Okay, so add up all those 15 points and you can still put the exact same valuation that this company on the public markets are what was going to happen on this private buyout from another foreign bank. That's absolutely crazy, just ludicrous numbers, and the fact that these are rated at the exact same valuations. Don't give up on the idea that SoFi is undervalued, okay? You're not missing something. This is what's called valuation compression. Valuation compression can destroy investments for people, okay? You take a stock like SoFi that had a price to sales ratio of around 11 to 12 times, like honestly 6 months ago. Okay, now it's around 5.5 times, and that's a 50 to 60% drop from where it was, even though the business has not changed at all. We're still continuously growing our revenues, continuously growing everything. Growth rates could potentially see a little bit of a slip off in Q1, and people are obviously expecting that, so they're, sort of changing how that is, but that's not a drop in revenue. That's a drop in growth rates. That huge multiple compression cut down is what's changing this stock from being a $20 stock all the way to a $7 stock, and that's crushing investors. Just be a little bit more patient is all I'm saying. The stock price doesn't need to go up 1% every single day, okay? As long as what the actual company is doing, the members are growing 1% every day, then the stock price can get very, decoupled from where that actually is. But that also means the stock price can be way undervalued from where we are and way overvalued. But it's time to buy when it's undervalued and sell when it's overvalued. Right now, if it was my opinion, I think we're way undervalued, and so I'm accumulating like crazy. But, this is a great quote. Fortunes are made coming out of recessions, and you won't even have to nail the bottom. This is a very important quote, and although we're not necessarily at a full, recession in terms of the overall stock market, we are in the growth sector, okay? Growth sectors of the stock markets are seeing 50, 60, 70% drops in some of the small cap stocks and sectors, okay? It's very important that if you do believe in these companies, and you know your research, and you know what the company is doing, their growth perspectives, their total addressable markets, that you accumulate when they drop like this, because you're going to get so much higher of value whenever the company actually does go to return to where it should be at potentially higher valuations, whenever that valuation compression actually starts to ease up and people feel more comfortable coming back into the stock market. If you're actually watching now, whenever the stock is actually down at the $7 ranges, it means that you do really care about this investment, because most times, all the retail investors flock in whenever it's actually at its green. But that's not what Warren Buffett does. That's not what a lot of the big investors do. They buy when there's blood in the streets, right? When the stocks are hurting, whenever all the fear is totally engulfed in this stock, you have to buy against the consensus of the market to actually outperform, right? If you're going with the grain, you're going to get crushed. There are going to be some red days in your stock portfolio if you invest the way I do and sort of look for the good green news in these beaten down stocks, okay? But I guarantee you that the performance way outperforms the broader markets whenever you actually do hold on to these stocks enough to see the other side. It happens all the time. We saw it in 2018. We're going to see it again in 2022. But if you hold through, you'll see stocks like Nvidia, Tesla, all these things back in 2018 pumped through so strongly, and they'll be some of the strongest investments that you could have made at the time. But if you want to learn more about SoFi, you can check out my deep dive on the company. It actually goes over the Q4 earnings call. You can kind of see, a little bit of a roadmap of what they expect to happen going into the future. But until next time, guys, make sure you guys give me a like and subscribe down below if you want to see more financial content just like this.